I hope you're ready for this one, ladies and gentlemen. Here in this video, I will discuss when I personally expect Tesla stock will recover. Now, things can change. I can clearly be wrong on this, but there's a couple important dates that I will highlight the importance of and how things could start to shift. Okay, first and foremost, we have to acknowledge something. The markets are in a very weak place. The markets are not nearly as strong as what the, let's say, headline S&P would suggest, okay? And I'm not going to, saying they're strong is kind of a bad way of putting it, but relative to the actual weakness you are seeing, the S&P is down about, 4%, 4.5% from all-time highs, but really under the surface, it's much worse than that. There are three metrics of market strength or weakness, if you will, indicators that I like to share with you on a regular basis. Okay, because I'm a bull. Long story short, I don't think we're heading into a bear market. I'll share with you, though, in this video what could cause us to go into a bear market and what I think the likelihood of those things are. There's three in particular, but there is three indicators that I like to share to show you market sentiment. And when you're this negative, usually you want to be buying the dip unless we are going into a bear market. Now, normally when you're this negative on markets, the S&P's down 10+%. So the fact we're only down 4% is kind of misleading, I guess. Misleading strength, if you will. The RSP is down almost 8% from all-time highs. That looks a little more in line with where some of these indicators are. First one, percent of stocks above their 50-day moving average at 28%. 6% of stocks fell below their 50-day moving average alone on Friday. That means 72% of stocks are currently in an active downtrend. That's a bad number, okay? Normally, you don't get this low. Even during corrections, like on August 5th, you hit a low of 31% of stocks trading above their 50-day moving average. 69% of stocks were in a decline then. So it's even worse than that. And you were down 10% from the highs on August 5th. Back in April, you were down almost 8% on the S&P. You hit a low of 26% of stocks trading above the 50-day moving average. So you're basically back down to that level. AI Investor Sentiment Survey almost never goes negative when you're in a bull market, even during a correction. And what negative means is there's more bears than bulls. Bearish investors at 37.4% and bullish investors at 34.7%. Okay, so almost a 3% difference here. 3% more bears than bulls. Neutral investors at 28%. And finally, the CNN Fear and Greed Index coming in at 27 today is almost in extreme fear territory. Now, why I'm highlighting these things to you is simple. We are already extremely bearish, okay? It takes even worse news to get us to fall lower, meaning that if we're kind of expecting a baseline scenario of bad news, right, which we are right now, higher expected inflation, possibly zero cuts in 2025. Wall Street's pricing in like 1 to maybe a half of a cut in 2025. Like you're virtually pricing in the end of the Fed cutting cycle. You're pricing in, again, pretty extreme tariffs and higher than expected inflation. You have to get even worse news to continue to drive down markets from here, meaning you have to get larger tariffs than we expect. You have to get the realization that inflation is moving higher, and you have to get a continued strong economy, right? Kind of push on those fears of inflation and the Fed's cutting cycle, right? You need to get a Fed that continues to become more hawkish. If you don't see things continue to get worse, markets tend to bottom and reverse higher when markets are this negative. So we do have some important dates coming up. one of which is next week. And I will give you a rundown of all of your data points for next week. On Monday, you have consumer inflation expectations. We are expecting this will rise to 3.1%. Part of the reason why Friday was so rough was, yes, the jobs report, but it was also the 5-year and 1-year inflation expectations that skyrocketed well above expectations. I think why this happened is really because of tariffs and the expectation that tariffs cause inflation. Not that people are actually seeing inflation right now. I don't think people are looking around and saying, wow, prices are just going crazy. They're continuing to rise. I don't personally see that out in the economy, but I think it's just the expectation of tariffs that will cause prices to go higher. But we don't know what tariffs are going to look like, and we'll get into that in just a moment. On Tuesday, we have PPI. This is Producer Price Index. This is like, Dell or Apple's prices, right? How much are their costs going up, essentially, is what PPI is. We're expecting 0.3% on a month-over-month basis for the headline. Last month was 0.4%. So you're actually expecting a deceleration there. Core PPI is expected to come in the same as last month. Last month was 0.2% month over month, and you're expecting 0.2%. And core PPI year over year is expected to actually fall from 3.4% down to 3.2%. So PPI looks pretty good, if I were to say so myself. The TIPP Economic Optimism Index is expected to rise on Tuesday morning at 10 o'clock in the morning. That comes out. Last month was 54, expecting that to rise to 55.1. And the NFIB Business Optimism Index is expected to fall from 101.7 down to 100.8. You also get a speech from Fed Williams, and it looks like Fed Williams is trying to kind of cozy up to the Trump agenda. It looks like some people are kind of saying Williams looks like he wants to take over for Powell about 18 months from now when Powell's contract with the Fed expires. Now, on Wednesday, this is your big catalyst, like the biggest catalyst, okay? You get CPI. That'll come out at 8:30 in the morning. Core month over month last month was 0.3%. We are expecting 0.2%. So you are expecting inflation will decelerate, will slow down, okay? Now, 0.2% times 12 is 2.4%. That's still above the Fed's 2% target, but it's a big difference between 0.3%. 0.3% times 12 is 3.6% on an annualized basis. So you do not want another 0.3% number. That's not going to be good. 0.2% would be a really good number to get. Now, core year over year is expected to remain stable at 3.3%. Last month, it was at 3.3%. Excuse me. And then your inflation rate month over month is expected to remain the same at 0.3%, the same as last month. And year over year is expected to actually rise from 2.7% to rise to 2.8%. Overall, you're not expecting super hot inflation data. Given kind of what the markets are now expecting for inflation, that inflation is going to be moving higher, I think a benign inflation report would be good news. A lot of people assume that a strong labor market automatically means higher inflation. That is not a 100% guarantee. Now, government spending and supply issues affect inflation. That's what causes inflation. A strong economy can kind of amplify that, right? Growing wages, people are employed, they're spending money. That can amplify inflation, but it doesn't in and of itself cause inflation. And that's why I stressed last week that the jobs report, doesn't necessarily guarantee that we're going to have strong inflation numbers, right? That's not a guarantee that some people drew. So first big catalyst, January 15th. If CPI comes in lower than expected, or even meets expectations, comes in maybe on the low side of expectations, that's going to be a huge catalyst. Because the last thing you want is a weakening economy, a weakening labor market. We don't have that. Apparently, things are fine in the labor market. If things are fine with inflation, then we really don't have a problem. Okay, that's why CPI is important. You can have a strong labor market and low inflation. That is possible. Doesn't seem like people think that's possible, but it is a possibility. We had that for 25 years before our recent, couple of years of inflation pressures that we have seen recently. We will get as well at 8:30 in the morning on Wednesday, New York Empire State Manufacturing Index. You will get Fed Barkin, Fed Kashkari that will speak right after the CPI report around 9 o'clock in the morning. Fed Williams that speaks again at 11 a.m. Fed Goolsbee that speaks around noon on Wednesday. Thursday, you will get retail sales month over month, expecting 0.5%. Last month was 0.7%, so that would be somewhat a deceleration from last month. You'll get export prices month over month and import prices month over month. Initial jobless claims that are expected to rise to 210,000, but you're in a very low place. Last week, you came in at 201,000, again, really suggesting the labor market is doing just fine. And you will get Philadelphia Fed Manufacturing Index. Now, CPI is going to be the big catalyst, but retail sales can definitely move things depending how they come in, especially in regards to the CPI report. If the CPI report is weak and retail sales are good, that's probably going to be a good thing for markets, right? Now, if inflation is hot on Wednesday and retail sales come in hot, then the narrative continues. You will get Philly Fed data, CapEx index, employment, new orders, and prices paid, with a big focus that will be on prices paid, because we've seen with the services PMIs, the prices paid component really skyrocketed last month, and that's just expectations of higher prices. So it doesn't mean that prices are rising. It just means people are expecting higher prices. And that's some data we reacted to last week that was negative for markets. You will get business inventories and the NAHB housing market index coming out as well on Thursday. And on Friday, you will get building permits and housing starts, capacity utilization, industrial production, manufacturing production month over month, and year over year. So you really get a lot of data coming out next week, with the big data being CPI. Again, with markets this negative, you really need to see a hot CPI report next week to get even more negative from here. And trust me, if we do get a hot CPI report next week, we're in for a bit of a problem. Now, I personally think we're probably going to come in lower than expected on the CPI report, because the last 2 months, we've seen shelter inflation start to decelerate. Okay, if we see that again, with shelter being the largest component of CPI, you should get a surprise downside number to inflation, okay, to CPI. If that happens, then we can start to talk about the bull market recovering. And I think that could be the first big catalyst that could cause that. Now, the second big catalyst that will be coming beyond CPI is Trump's inauguration on January 20th. Now, there's news out here in the last couple of hours that Trump is planning 100 executive orders starting day one on the border, deportations, and other priorities. So you may know faster than not what the tariff picture could look like. Although, if I word search this article, there's no mention of tariffs at all in this article. Okay, there's none. So I think the markets want clarity. If we get clarity on January 20th or the 21st, that's going to be good. Now, I think we're setting up for a buy the news kind of situation. It seems like everyone's selling the rumor, and we could buy the news coming after January 20th, especially if we get an update on tariffs. Now, baseline, most people are expecting like a 20, 25, 30% blanket tariff. Wall Street is for sure expecting that. If we get, let's say, a 10% blanket tariff, then we may be a little bit too bearish right now on tariffs and what tariffs will mean for inflation. After all, even the Fed themselves are expecting tariffs will cause inflation. Tariffs are a one-time boost in prices. They're not long-term inflationary. Okay, so think about it like a CPI report or two could come in hot, but it doesn't tend to lead to, continued hot CPI reports. Okay, now a 10% tariff is lower, I think, at this point than Wall Street is expecting. I think a 10% tariff probably happens. Now, you may not see a blanket tariff. You may see certain industries that get tariffed. If we don't see a blanket kind of 10% tariff on everything, instead, it's industries that maybe are not very important to the US, that would be the best case scenario. Okay. And if that were to happen, then I would expect people are really going to throw out the window the whole tariffs are going to cause inflation thing. Imagine that. Imagine January 20th, Trump tariffs like car parts, or he tariffs, farm equipment or whatever, it is that is not systemically important to our economy. Then people are going to say, that's all? That's all we're getting from tariffs? Oh my gosh, inflation is no longer going to be this issue. And then the Fed's going to say, yep, the recent tariffs we have seen do not seem to be inflationary after all. And then markets are going to rip higher on that. Now, there is the off chance that Trump does opt for like a 25% blanket tariff on everyone, especially China. That may be a bigger issue. Then it's kind of wait and see mode to what that does to inflation. So I actually think that January 20th is probably going to be a positive catalyst for markets versus a negative catalyst for markets. Because at this point, I think expectations are really high for tariffs, that we're going to get some extreme tariff policies that are going to, cause a big round of inflation. Even the Fed believes that. I don't think Trump wants to destroy the bull market. I don't think Trump wants to destroy the economy. And that's kind of the basis of my argument. Now, if he does want to destroy the economy, if he does want to get, quote unquote, showed up by Biden, that's fine. I just don't think that's a part of Trump's personality. And this is more of a character gauge or judgment. I don't think Trump wants to be looked at as the guy that preceded Biden that destroyed everything. That Biden had 2 years of the S&P back-to-back 20+% gains, almost historical in and of itself, and then Trump came in and markets crashed, right? I think Trump's got a bigger ego than that. I think Trump wants to leave a different legacy than that. And that's why I do think right now is an opportunity in markets, since we have swung so far to the bear side. So I actually think a reversal in markets could come pretty soon. January 20th is going to be a big date, and I think next week's CPI report is going to be a big date. If we don't hear anything on tariffs on January 20th, then it's going to be more of a wait and see approach. We're going to be very sensitive to the tariff headlines that come out, but I don't think, generally speaking, tariffs are going to be as negative as Wall Street expects. Just imagine a scenario that inflation comes in around expectations or on the low side next week, and we get specific tariff announcements from Trump that are really not as bad as we expect. 10-year Treasury yields are going to plummet. Okay, that is what is going to be the trigger to cause a reversal in our markets, to cause Tesla stock to move higher again. Okay, I think it has to do with 10-year Treasury yields. Now, 10-year Treasury yields below 4.5%, not really a huge issue. But as 10-year Treasury yields get close to 5%, it's the velocity of the move higher. It's only been a couple of days that yields have broke above 4.5%. Now they're at 4.76%. People are like, oh my gosh, if we get a hot CPI report, if Trump tariffs are too aggressive, people start to speculate that 10-year Treasury yields could go to like 5.5% or 6%. People go crazy with expectations. Okay, so if I'm correct and CPI is lower than expected next week, and Trump tariffs are not as bad as expected, you could see 10-year Treasury yields back down to about 4.3%, maybe even 4.2% in just the course of like a week or two. If that were to happen, that's really going to free up some room for markets to move higher. Now, if the CPI report is like really good or something, then obviously you're going to see more of a dramatic move higher in markets. But I think 3 to 6 months from now, we may be saying, inflation's continuing to make progress. The economy's holding up. I think earnings are going to come in good as well. We do have earnings that start next week, and I'll share that chart with you in just a moment. But I think we're also going to say tariffs were not as bad as we think. All of a sudden, we have a perfect cocktail for a very strong 2025. And I think that's ultimately what's going to happen. Okay, again, with the backdrop of Trump doesn't want to be the guy that ruined the bull market. I could be wrong on that, but I don't think that is what he wants to do, okay? Now, this week, you start off with some major earnings. On Monday, you have KB Homes. On Tuesday, you have Applied Blockchain, Applied Digital. On Wednesday, you have JP Morgan, Citi, Wells Fargo, BlackRock, and BNY in the morning. You have a couple names in after hours. Thursday, you have TSMC, United Health Group, Goldman Sachs, Bank of America, Morgan Stanley, US Bancorp, First Horizon, M&T Bank, and PNC that will report. Friday, you have SLB, Regions, Truist, State Street, Independent Bank, Citizens Bank. So lots of banks that are going to kick off earnings. TSMC likely to have strong earnings. Foxconn, which is kind of a competitor to TSMC, reported really good earnings. Revenue was up like 42% year over year. I don't think we have much to worry about with TSMC's earnings, but if earnings were to not be as good as expected or something, that would be a problem for markets. I think at this point where stocks are at, you're pretty well priced for a bad earnings season. So even okay earnings or good earnings, probably going to be enough to send markets generally higher. So just to recap here, you have the inauguration on January 20th. If we get some tariffs, which 100 executive orders, I'm sure we'll get some kind of tariffs coming out, and they're not as large as expected, that's going to be a big positive. That's going to draw down 10-year Treasury yields. That's going to boost up markets, considering we are so negative. So January 20th could be a buy the news event. I think we're selling the rumors right now. January 20th, we likely buy the news. We have earnings that start up next week that are probably, there's no reason to expect earnings are going to be bad. There's nothing I can point to that says this earnings season is going to be bad. So I think that's probably going to be a positive and reinforce, help reinforce the bull narrative. And then next week we have the CPI report. If that comes in lower than expected, I don't think it's going to be a huge downside surpriser, but as long as it's in line or lower than expected, even slightly, I think that's going to really push down those 10-year Treasury yields as well, which will be the catalyst to push markets higher. 10-year Treasury yields is the reason why markets are really falling at this point, or the main reason. And if those yields revert lower, then you could see a recovery in markets. And I think that is the focal point of Tesla stock. And considering the stock's at $393 per share, you've really removed a lot of the excess excitement or fluff, if you will, to Tesla. And I think right now is a great opportunity to get into Tesla if you do not have enough exposure. If you can sit here and say to yourself that you'll look back 10 years from now and say, wow, I should have been more invested in Tesla. I knew this was such a large opportunity with Robotaxi and Optimus and everything else that's going on at Tesla. And you feel like you don't own enough that you would regret not owning more, then I think now is a great time to add to that exposure. Now, if you're all in on Tesla, I doubt you're going to have those regrets, right? But if you don't have enough in Tesla and you feel like you would have that regret long term, then perhaps now is a good time to look into owning Tesla. But in the adverse event that we don't get any tariff news on January 20th. Inflation comes in hot next week. Earnings are not as good as expected. Then we're in a much bigger problem. Then markets would continue to fall. And it's really hard to say what would happen then. But we could target the 200-day moving average on the SPY, which could be downside of about 5% from here. I doubt we go any lower than that, but 5% is a decent amount to fall, right? That doesn't feel great when you're in that would be an almost 10% correction. So let me know what you guys think about this information down below in the comment section. These are kind of just my thoughts. This is kind of how I'm thinking about things here. And I think I'll be right, but there's a chance I'll be wrong. So I'm not a financial advisor. I'm not a financial planner. Even though I am about to take my Series 65, I cannot give you personalized financial advice. So contact a financial advisor for your personal situation if you feel like you need to. Thank you for watching, ladies and gentlemen. Enjoy the rest of your day and your weekend. I will see you in the next one.